Hello YouTubers, welcome to the Independent Investor. For Monday, the February 24th, today we're seeing what I thought we would have seen a couple weeks ago with the coronavirus. And then in my video back then I mentioned that I thought the market was underreacting to the potential damage this virus could do to the economy. It seems today the market's waking up a little bit with a lot of the major indexes down 3%. So because we're towards the end of a bear market now, a lot of people have been buying the dips and that has worked and it's came back. But what I do now is kind of rapidly go to cash, and then if it looks like the market's going to turn around, slowly buy back in again. And that's worked reasonably well. I even mentioned I went to cash over 2 years ago. Was scared of overvaluations at that time, but continue to see the Fed printing money and expected the market to probably become more overvalued, which it did, so I got back in again. So this time I think might be different. It looks like this could put the United States into a recession. This maybe just being more of a catalyst, because it'll show quite a bit of economic data now that's going, over a year or two, where we're seeing things slow down. For one example, we see the leading indicator in the United States now has been flat, trending down since about 2015. It hasn't really dropped off a lot, but the trend has been pretty steady. And the leading indicator looks at all the different states. Coincident index combines those. It also looks at the state of the housing market, which surprisingly has been relatively strong. It looks at state unemployment insurance claims, and also looks at ISM data and the 10-year 3-month Treasury bill. So it combines those into an index, and that index has been kind of trending down, as it might be hard to see on that chart, but it's been fairly consistent downward pattern. So because of this, I mentioned a couple of videos ago, I went quickly to cash 30%. Today I did more selling. Now at 50, probably over 50% cash. And I've also opened up short positions. I'm not sure if they will work or not. The market could turn around and head up, and I would probably have to buy those shares back that I sold at a loss. But with the market being down on Friday, I thought maybe it was a good time to open a few short positions. I've also done a lot of short calls, trying to just keep that premium. I'll show some of those later on. So, and the stocks that remain in my portfolio are very low beta stocks. Beta is just how much the stock moves relative to the market. So if you have a beta of 0.5, that would mean if the stock dropped 10%, your stock would only drop 5%. So that's the REITs. A lot of the Canadian REITs really aren't affected by this coronavirus right now. And also pipeline stocks, which have been a favorite of mine for a long time. So stocks like Kinder Morgan have barely moved today. Another index I came across just doing some reading was the transportation, and it's called the Case Freight Index. And it's a data that includes all domestic freight modes, so rail and truck, and it's a company that does this and basically tracks $28 billion in freight transactions annually for hundreds of large shippers. These companies represent broad range, so it's consumer, packaged goods, food, automotive, chemical, OEM, retail, and heavy equipment. So this, which I just plotted the other day when I came across it, has dropped quite precipitatively. We were up at 1.2 and it came all the way down to 1. Now it has been at this level before, but it's just a little bit more evidence that things in the economy may not be as good as what's being projected. So again, all these, this spreadsheet I just made up, you can put a Fred insert and then download all the data directly from the Federal Reserve in the United States. So it's pretty handy. You can get a pretty good handle on the economy just by looking at 20 or 30 so important charts. I also have another one that just tracks rail, and it's also dropped off in the last few months. So rail freight here, we can see it kind of peaked, and then it's been trending down now for about the last year or so. Again, none are really in recession area territories, but the trend is definitely on a downward pattern. So one other thing I wanted to, which I found, I talked about the Fed balance sheet quite a bit and how this has really propped up the market, especially around the world. There's been Fed printing money in Europe, Japan, United States, and that has really been supporting the market. And you can see here back in 2019, if you remember, we had a pretty serious correction in the market. I think it was down 10% at one point. And you can see that kind of coincided with the Fed bringing down their balance sheet from roughly 4.5 trillion down to 3.8. And then with the market correcting so much in such a short period of time, they kind of got scared, and you can see it's reversed and we're heading back to where we were before. So years ago this was meant to normalize maybe at 2.5 billion, but we can see now once they do that, they can't no longer control interest rates, the markets start to correct, and they're scared that would lead to a recession or even deflation. So this is kind of a good one to watch, is just what the Federal Reserve banks are doing with their balance sheets. And that symbol for that is if you go to the Fed, it's just WALCL. Put that in and you can just download the data. Also corporate earnings, which I mentioned. I think last week. Yeah, so corporate profits, you can see here, totally flatlined. So the market has just been going up by expanding its P ratio and valuations, which isn't sustainable because earnings have to really support the market at some point. So we can see now earnings have been flat going back to going back almost 3 years there now. So again, that's just another sign. And the federal, in the past when there was a recession, they had really two ways the Fed could bring down interest rates, and typically they'd have to bring down interest rates by 4%. to stimulate the economy enough to get the economy going again. And now we've got rates at just 1.5, but even below that. So now you'd have to go to -3% to get the same kind of stimulus. And when you're going minus, there's arguments that you don't get the same effect as we've seen in Europe. If they've gone to negative rates, it really hasn't helped too much. And I don't think it's possible that we could ever have negative rates that much. So the Federal Reserve itself is running out of gunpowder to stimulate the economy. The only other way then to stimulate the economy is through fiscal measures, and that's the government. And we've seen Trump basically pile on the debt. I think I have it here. Yeah, so you can hard to see here, but actually we had basically a balanced budget. In 2009 came along, the fiscal stimulus, they went down to actually a $1.4 trillion deficit to try to get the economy going. And they tried to reduce that down to 400 billion. It came back as the economy improved. But when Trump came in with the tax cuts and everything else, we're trending back down almost to 1 trillion again. So it's going to be hard for the government to even stimulate too much if